Hi, everyone. This is Jason Barrack of Wall Street from E Street. Welcome back to another Wall Street from E Street podcast interview. Today's special guest is a returning guest. He's a friend of mine. He's actually a local guy, but we met through the internet. He's the founder of 720 Global, which provides research work for institutions, and his articles appear frequently now on Zero Hedge. Michael Lebowitz, thank you for joining me again.
Thank you once again for having me, Jason.
Now, Michael, the Federal Reserve came out this week, and they were talking about interest rates. And I guess as of right now, they don't plan on raising interest rates again the rest of the year, but I guess they can change their minds. Do you think the Fed is trapped to the point where they can't raise interest rates anymore? Or do you think the path of least resistance maybe is they're going to start bringing things down again in the near future, maybe back down to this talk of negative interest rates like some of the other central banks?
Yeah, well, I think what happened this week with the Federal Reserve was very interesting. They took a much more dovish approach, meaning that they were expected, based on their own language, to raise rates four more times this year. And now the expectation is that it's one or two. And that's based on the language that they used in their most recent statement. But what I find most interesting is that if you look at, and the other thing they've said, let me go back a little bit, through their speeches, is something to the effect that we're very data dependent. We want to see what data looks like over the next month or so and base our decisions on that. And we know that they're data dependent. When we talk about data dependency, it's obviously all things economic, but they focus on jobs, they focus on inflation. So when we go back and look, we've had some jobs data. Jobless claims are dropping like a rock. They're doing great. The jobs number, the headline number was good. There's certainly some pieces of it that were very disturbing, but all in all, jobs have been doing well. We've seen a little uptick in prices. Not calling for outright inflation, but there's certainly been an uptick in inflation. So and in general, and this is seen by the City Surprise Index, which is almost back to zero now, that data is starting to come in a little stronger than expected. I'm not calling it a boom or anything like that, but considering that the Fed was on the fence about going in March, when we were in January, maybe early February, the Fed was on the fence about going in March, and then we saw some of this better jobs data, inflation data. It's kind of weird that not only did they not go, but they kind of took a step back, and they lowered their pace for the rest of the year. And what I attribute, why I think that's occurring is, I think they are very concerned with the markets, and I'm not just talking the U.S. stock market, I'm talking the dollar and global markets and bond markets around the world. And there's been some talk of this over the last day or two. At the last G20 meeting a couple weeks ago, there seems to be, it appears there's some kind of accord that the central bankers got themselves into. And what I mean by that is, prior to the last 6 months when the Fed went off on this hiking cycle by themselves, the central banks seem to be on a carousel. It would be one person's turn, then the other, and it just keeps rotating. And they kind of got off that cycle. China was starting to devalue. Japan and Europe were kind of fighting each other, who could do more QE, who could do more negative rates. And America was off on our own, raising rates, going the opposite, and that was clearly roiling the markets. And I get the feeling that something came out of that G20 meeting where basically what they said is we can't fight each other. So if we look at what has happened since then, the Europe basically went full bazooka. They lowered their negative interest rate more. Their QE, and they're doing QE on corporate paper. So it's apparently their turn on the carousel. Then you got Japan, which somewhat surprisingly did absolutely nothing at their last meeting. People thought that they would take more action, either increase QE or lower their negative rates even more negative. And the U.S., as we just discussed, was much more dovish than anyone had expected. And most recently, the Chinese have appreciated their currency pretty significantly over the last couple of days. So it appears there's something going on. These guys are talking to each other, and they're trying to get their acts together. So, yeah, I think the Fed is acting in concert with what they've talked about and any kind of agreement, whether it's, it's certainly not ironclad, but there must be some kind of agreement. And that, I think, is what's driving the Fed. And they say they're data dependent, but clearly they're not.
The funny thing is, a lot of the people on the mainstream financial media, and we've also heard this from some Federal Reserve members, is they've been blaming China for why global markets have been acting up. Xenophobia has always been a common excuse for one country when one economy isn't doing so well. But you say how the U.S. economy is doing pretty good. A lot of those numbers are cooked; they're fake. I mean, the labor participation rate in the United States is at multi-decade lows. A lot of the people who were on the jobless claims, they've gotten kicked off because they've been on unemployment for so long. Maybe they're not even counted anymore. But I also think that the Federal Reserve is trapped at some point. I think maybe they try another token interest rate or two raise sometime in the near future. But if they try a couple of those, something in the real economy, something in the asset markets is going to break, something big that maybe we didn't foresee. Maybe the Federal Reserve knows about this. Maybe another central bank in another country knows about this. Maybe it's Deutsche Bank. Maybe it's Italian banks. Maybe it's some of these larger oil companies like Petrobras or some of the others that, they have way too much debt. They have ridiculously bad debt to equity ratios and things like that. So I think, there's so many potential dominoes that can fall right now. I think, it's the central banks feel like they have to coordinate with each other because they have to get updates on everything because everything is so fragile right now, whether it's China, Japan, Europe, or the United States.
Yeah, I agree 100%. And earlier when I was talking about jobs, I don't know, I kind of stuttered a little bit. And I stuttered because what I said was the jobs report on the face of it was good. But just like you said, I know full well that the jobs report is not good. And there's a lot of stats that come out, but really what you can really just look at are wages. If the employment market is full, wages will go up, and wages have not been going up. They've been flatlining, and this has been going on for years and years. So the numbers can say whatever they want, but if people aren't getting raises or paid more, there's obviously not a shortage of labor in the market.
Yep, and we also see evidence that the real economy is doing very, very poorly. Look at all the store closings. Sports Authority, which is one of the largest retail sporting goods stores in the United States, they just filed for bankruptcy. There's enormous amounts of restaurant closings, and there's enormous amount of retail store closings. If these things are these stores closing is not normally what's happening in a good economy. If the economy was good, these stores would not be closing, and they would be building more stores. But I think it's a combination of factors of you have e-commerce, you have Amazon be willing to basically sell some items either at cost or below cost to subsidize losses because their stock is so high that they can get away with it for a while and put competition out of business. And then you have the consumer who just doesn't have the savings and the discretionary spending that they did a decade or so ago to be able to go out to the sporting goods store and spend $500 or $1,000 on new toys or go out to eat quite often each week.
I would agree. Definitely agree.
Now, Michael, gold has been the best performer, gold and gold stocks, and also Bitcoin. Bitcoin has been another top performer too, although it's not as big a market as a lot of the regular markets. But are you surprised then that gold has had such a nice rally considering what's gone on with these central banks in the last, really since 2016 has started?
Yes and no. I mean, I always suspected. I've been a big fan of gold for quite a few years. And I have based my bullishness on gold, not necessarily on inflation, although I ultimately think at the end of the day we will get it, but more just on the confidence and trust in dollars, in pounds, in euros, in yens, et cetera, and in the central banks that run those. I think that gold is a good barometer for trust and confidence in those institutions. So when were people going to start to see chinks in the armor? It was hard to tell, but maybe it's this negative interest rate and negative yields across good chunks of sovereign debt curves that's just causing great concern. There's also a big difference between paper gold, paper silver, any paper commodity, and the true commodity. the raw commodity. And in the futures market, prices can be smashed well below the point where economically they shouldn't go, where producers produce and where they should stop producing. So to me, it was just a question of time, and when would concern start showing up for the central banks, and that happened, early this year. Wasn't necessarily surprising. I'm encouraged at how strong it's been. We've gone through some technical points that have been holding us back in the past. So I'm cautiously optimistic. But again, gold is a barometer, and while I'm not going to directly claim manipulation, it's certainly in the central banker's best interest to keep the price down. You don't want your a key signal of the Fed flashing red. So I'm encouraged. Silver's been picking up recently too, but I'd like to see more of it. Especially not. It hasn't been as dependent on the dollar, which is also very encouraging. It's kind of started to trade with much less correlation.
Yeah, I mean, at some point, the U.S. dollar and gold may rise. So the dollar index may get stronger and gold may rise. Just the dollar and gold aren't always contra assets. Correlations can and do change. A lot of people out there think, correlations always stay the same, but they frequently change if you go back and look through financial history. Look what was happening recently with the oil price and the stock market. When the oil price was going down, the stock market was also going down. Well, that, in my opinion, that was because a lot of sovereign wealth funds, the Saudi Arabias, the Norways, they had to dump enormous amounts of their equities to raise cash in order to bring that cash back to their country to protect their own economy. So I think one of the reasons also the gold price did start to find a bottom was because there was physical supply problems of sourcing large amounts of gold. And I'm not talking, going down to the coin shop. I'm talking like 100-ton orders and larger and things like that for entire governments, because look how much China has imported, look how much Russia has imported, and things like that. But I also think people were worried, when the oil price did start to collapse, that, this was going to create contagion. If the oil price, and obviously I'm going to ask you about this, if you think this oil market rally is real based on fundamentals, same thing with the base metals, but I don't think it's real. If the oil price goes back down to $20 or $30 a barrel, I mean, we're going to have some enormous bankruptcy risk, either with the oil producers themselves, large guys like Petrobras or others, or actually the banks that are holding enormous amounts of oil loans that they haven't been able to dump on someone else to get rid of.
Right. The other thing which we didn't really talk, I think you mentioned it, but we didn't really talk about is NIRP, or negative interest rate policy. And there's something, it's one thing to have an interest rate go from 4% to 2% to 1% to 0.5%, even to 0. But when you start charging to put money in a bank as a deposit, it's different. It's very different, and you've changed the dynamics completely. And Japan just went NIRP over the last couple months. Europe has been in NIRP for a little while. U.S. is not, we're still in theory raising rates, but I would certainly say NIRP is a potential even as early as late this year. And in England too, they've been talking about it more, where it wasn't feasible at one point. So, I think the general public, when you talk about things like negative interest rates, to them that's a red flag, that you can basically give money away for free, and that's not good enough. And that may also be driving gold, because there's finally something in front of them that helps them realize that the Federal Reserve and most central bankers are pretty much at the end of the road.
Yeah, people aren't getting paid any interest at the bank for keeping their money there. They're getting charged if we do go to really draconian negative interest rates. I personally think negative interest rates are, the end game for Keynesian economics. Negative interest rates to me, Michael, if we get up to 3 or 4% per year negative interest rates, that's a wealth redistribution scheme to me. That's something, the Marxists would absolutely love, that they're forcing you to spend, they're trying to drive wages higher, they're confiscating your money. As soon as you put more money in the bank, they're taking an even larger cut of it. It's amazingly frustrating that, you can't have a real recovery without savings, and yet here are the people in power trying to dissuade anyone from saving any money.
That's right. I mean, I'm actually writing a piece now on negative interest rates, and I actually have it in front of me. This worked out well. I wrote this line. It still is going through edit, so it may change, so don't hold me to it, but it goes, as children, we were properly taught by our parents to save money for a rainy day. The actions and policies of the central banks are now telling us that we should teach our children to disregard prudence and spend money like there's no tomorrow. And sadly, it's hard to refute that statement.
Well, the people in power don't want us questioning it. It's just messed up. I mean, it's common sense that you should have money set aside for emergencies and savings and things like that. But, they're trying to breed the common sense out of us. This is what happens at government schools, where they don't even teach kids in high school how to balance a checkbook. I mean, that should be a class where you should learn how to read financial statements and learn how to balance your checkbook. That should be one of the major things that people should learn, like in basic education, and it's not.
Oh, I agree. My son is a sophomore in high school now, and he is taking base level economics, and I have kept my mouth shut. I won't talk to him until after the class is over because I want him to get a good grade. But what he has been learning so far has been appalling to me.
Oh, I'm sure it's full Keynesian economics, and it's not called Keynesian. So it's just like, it's just regular economics. It's unquestioned. Michael, are you surprised the stock market hasn't crashed yet?
Yes and no. I mean, the stock market is grossly overvalued, and I think it easily could get cut in half, if not more. That said, there is still trust and confidence in the system and the Federal Reserve, and that Federal Reserve has the ability to spike the market, regardless of how overvaluated it is. And I also understand that there's a technical aspect, that a lot of times tops are processes, that they take a while, that you have to beat back the old logic. The old logic is that you bought a dip and you were better off for it. And for that logic to go away, investors have to continually lose money buying the dips. And even now,
what happened sorry to interrupt. Just like what happened in gold in 2011, how a lot of people have been selling gold since it's been falling since 2011. Yeah.
Right. And but eventually the mentality changes, where bears start making a little money and they get a little more, they up their positions, they get a little more bold. Bulls start realizing, you know what, I know there are even some bulls that understand the market's grossly overvalued, but they think they can sell it to a greater fool. Well, at some point, even some bulls realize they're going to be the greater fool if they don't sell it. So the whole mindset has to change. And I think we're in the process of changing it. I'm a little surprised how far the market rebounded over the last month or so. But again, I still think we're in that topping process. And I still seem to think there's a small chance, I don't put a lot into it, but there's a small chance we could even go up to 2,200, 2,300 in one last hurrah before the thing really comes crashing down. But at the end of the day, I think if we have this conversation a year from now, you'd be more than happy to have sold your stocks today or to even get short today. But, trying to understand what's going to happen over the next day, week, or even month is, it's like rolling craps in Vegas.
Yeah, you've written a lot.
I was going to add one thing, and you may have just been getting to this point. We've written 4 articles on buybacks.
Yep, I was going to bring that up. Yep.
And it's very possible that buybacks, and I've seen some work done on this, that buybacks are a main driver of this rally. And some of that makes sense, right? Because a corporation they don't have a P&L like every other trader. They're just buying the stock back. They don't care. they are incented to push the stock higher in the short run so that their executives can get compensated. But it's a limited amount of buyers, and with credit ratings starting to drop, with corporate leverage starting to increase, the amount that corporations can buy back will be less and less going forward. We actually wrote a paper on ConocoPhillips, which is a company that we actually kind of like a little. But what they did was they bought back a ton of stock back in 2012, 2013, boosted the price. The CEO retired, got an incredible golden parachute deal, made hundreds of millions, and now the stock price is roughly half of what it was then. And the company is out, I don't have the numbers in front of me, but $15 to $20 billion. Can you imagine if ConocoPhillips had $15-20 billion? They wouldn't have cut their dividend that had been one of the longer standing dividends on Wall Street that had been steadily increasing through 2008, when, remember, oil went from about 140, 150 down to 40 or so. They would also be able to pick up some of these companies that are basically on the verge of bankruptcy, have some valuable assets, and they'd be able to buy those for pennies on the dollar. So buybacks, what we're seeing now, and really just in the energy sector, are how buybacks in the past are killing these companies today. And some of these companies are actually having to issue stock now to raise money, which is very disturbing considering that they were buying back stock at 2 or 3 times the price that they're now issuing stock at.
So they're doing things the exact opposite then of what a prudently run company should be.
Right. You should. There are times when you should buy back stock, and that's when a stock is trading below its intrinsic value. When you do not have investments you can make in the future that will grow the company. But that is not the case with a very large majority of the buybacks that have occurred over the last few years.
Yeah, there's a lot of, not just oil companies, there's a lot of other companies with too much debt from stock buybacks now that are starting to feel the pain. So it might not occur in the next couple quarters, but over the next couple years, these companies are going to have similar problems to exactly what you described with ConocoPhillips. I want to ask you about this rally in oil and base metals. Do you think it's based off of fundamentals, or do you think it's mostly short covering?
Short covering. I think there's some greed too. I get the call a lot. Can I buy oil now? Can I buy oil now? There's a lot of people that basically see it on sale at 50% off, and they think it's a great long-term investment. And I think if you're a very long-term buy and hold and aren't going to look at your portfolios often, it probably is here. But I think you're starting to capture some of those people that say, look, I'm going to buy it at 30 and I'm going to sell it at 80 6 months from now, and I don't think that's the case. It's hard to say, but it wouldn't shock me at all if oil got back to its lows and even went lower after this. The shale industry is to some effect part of the bubble. The Fed was giving out free money, and a lot of these oil companies took it. Indirectly, not from the Fed, but they basically were able to borrow money at dirt cheap prices, which made all their investments look great as long as oil stayed above 60, 70, 80 bucks a barrel. But that is not the case. And that's why we are seeing an incredible amount of production of unprofitable oil, because a lot of companies, especially smaller companies, have huge debts that they have to pay back. And the only way to pay them back is to keep the cash flow going, even though it's unprofitable business.
Yeah, that's a good point. And another thing that we're starting to see right now is over $10 billion in equity has been raised for oil stocks in 2016, and that's despite these low oil prices, the bad balance sheets of so many of these oil companies. Do you think the banks are doing this then as some type of way to de-risk all their credit and bad loans that they've given out?
Well, I think you are, not all of it necessarily, but some of it. I think Weatherford was one company that basically issued stock and used the funds to pay back a revolver facility from the bank. So if pick a bank ABC, we're not going to use real names. Bank ABC lent money to Weatherford. And now Bank ABC is very concerned that that money is worthless, that they're going to get back 20 cents on the dollar. Well, what options do they have? They can't sell the debt because the market will pay them 20, 30 cents on the dollar. Well, what if they can somehow get more financing for the company? And that's what they're trying to do. So they're basically issuing stock. Same banks they're basically issuing stock and using those funds to pay off loans and revolvers and such. It's, not ethically sound or morally sound, but the bank is basically taking off a credit problem off their balance sheet and putting it onto new equity holders' balance sheets. It's like I said, not ethical, not moral, but it's legal.
So it's very buyer beware then in oil. People have to be good stock pickers. They have to be able to read the balance sheet then and see that the company doesn't have too much debt. Their debt to equity ratios are good. Their debt to cash flow ratios are good. Because it's going to be a big red flag if we see a company sell a lot of shares and then they say that they use the money to pay off their debt.
Yeah, I think a lot of equity investors tend to focus on the income statement. And I think, especially in energy space, they better be focusing on the balance sheet because, I'm not talking about the big boys, the Exxons, the Conocos, but for those the smaller companies, lower market cap companies, they better focus on that balance sheet, on the debt that's coming due, on the cash flow, on cash, accounts receivable, payable, et cetera.
Do you see value in any industry in stocks right now? You mentioned a little bit about oil, so I think maybe people can stick a toe in. I don't think this is the bottom for oil either. I don't think we've seen nearly enough bankruptcies or major scale production cuts because these companies had hedging for a couple of years. The hedges are just starting to come offline, and these companies are still some of them are still expanding the amount of debt that they can take on from revolving credit facility and also sell shares. Where else do you see value in the stock market right now? Is it in gold stocks still?
I certainly think there's value there. I mean, those stocks have gotten destroyed. And yes, they've had some great runs, both individually and the broader indexes and things like GDX and GDXJ. And they could certainly and probably will pull back at some point. But I still think, and part of this is based on my outlook for gold, that there is significant upside there. There's also some upside in I've been paying some attention to the mortgage REIT sector. And what's interesting there is that you have companies that are trading at discounts of 10 to 15% to their book value and paying decent dividends. Now, a lot of that is predicated on the yield curve and swaps curve, and it can go very bad for them. But for the time being, I think there are some values in, kind of with that fixed income equity type hybrid space that are worth trying to pay attention to. I think on our last call, we had mentioned some closed-end mutual funds that were trading at 15% discounts to their net asset value. And since then, a lot of those have closed that gap significantly, and they've returned anywhere from 5 to 12% over the last 6 months, 9 months. But there aren't too many areas where I see incredible value. Some of the mining spaces, some of the energy spaces, but in both cases, you have to have a iron stomach and just be willing to potentially ride losses until they're not losses anymore, and kind of average your buys down if need be. Natural gas as well, I think, is slightly more attractive than the more traditional oil space. So, but
except for Chesapeake Energy.
Of course, right. To be in Chesapeake Energy, you really have to understand that's almost a legal game now, and a bankruptcy play is what it appears to be turning into. So you have to be a specialized a trader investor to be playing in that market, at least that company.
Yeah, I think if you know what you're doing and how to value the bonds, you may be able to buy the bonds at a discount if you buy the right type of bonds. But, the retail investor should not really be doing that. That's something, more sophisticated hedge fund managers are probably going to be doing.
Yeah, but there is, that's a good point. There is some in the energy bond arena. There are some good deals. But again, you have to understand those balance sheets up and down and sideways and diagonal and every which way. They do pay some nice yields, but there's certainly some risk, and you have to understand their cash flows and their future debt payments and what they need to keep those companies going to the point where oil is it could be a few years before oil rises significantly again.
Yeah, it's tough to say when oil is going to fully bottom, although I think, one of the major signs is going to be on the supply side, where we do see these shale producers that are being given way too much debt and equity when they finally do stop producing and or go bankrupt, or they're bought for pennies on the dollar by maybe ExxonMobil or Chevron, and then those guys temporarily shut down production for 6 months or a year or something like that. I think that'll start to signal a bottom, but we haven't fully seen that yet. But I am very bullish, though, that I think we probably have seen a pretty good bottom in gold stocks, just by the way the gold companies are acting. Although, some of these gold miners now, they're starting to sell massive amounts of shares for really stupid reasons. It's not to do acquisitions. It's not to go buy more gold ounces in the ground. It's to pay off bad balance sheets and things like that. So I would tend to avoid the gold and silver companies who are not going to use the money that they're raising right now very prudently.
Yeah, and I think we had talked about this the last time, but if you're not able to go in depth on a company's books, I would stick with more of the funds or even the royalty companies. The GDXs, the GDXJs, there's some good mutual funds out there that are basically doing that work for you. And the returns may or may not be as good as owning individual companies, but the risk is diversified, and you do have experts that are combing through these balance sheets.
That's a good point. There's also the new Sprott Gold Miners ETF, so that there's a larger one, and then they have a junior one, and then there's the Silver Junior Miners ETF, which my friend Andrew Chanin at Pure Funds, he started. That gives you a good diversified exposure to silver juniors, SILJ, on that one. But that's a great point about the royalty and streaming companies. You have a large gold royalty and streaming company like Franco-Nevada. They have over 30 sources of diversified cash flow. They can grow without debt. So that basically, owning a company like Franco-Nevada who's diversified all over the globe, it's basically like owning a gold mining ETF then.
Right. That's right. But, I think that maybe if you do want to dip your toes in energy and you don't feel comfortable reading the balance sheets and income statements, that's something to think about, is either an energy fund or an ETF of some sort. There are also, this is kind of a hybrid of what we were talking about earlier, there is, and I'm going to get the ticker, a BlackRock fund. The ticker is BCX, BlackRock Resources and Commodities. And they own all the big names in that sector: Exxon, Conoco, the companies we've been talking about. And it's basically a fund of those shares, but it's trading at I haven't checked it recently, but a 10 to 15% discount to the value of the underlying shares. So that's another way to think about potentially getting involved at a slight, at basically on sale.
Now, with the negative interest rates and some of the other stuff that politicians have talked about, we've seen governments and central banks talk about creating their own digital blockchains. What's your opinions then on this cashless society? Do you think like the negative interest rates and all these things are all symptoms of, big government wanting more control over your transactions so they can track them and tax them and things like that?
Well, I think these governments have gotten themselves in an economic hole, continuing to borrow consumption from the future. And in order to do that, they've had to continually lower rates. Now they're at the point where they've lost the ability to sway the economy. It used to be that if the Fed dropped rates from 6 to 5.5, there would be a lot of individuals, corporations, et cetera, say, wow, that's a good deal. We got to borrow some money. We got to invest it. We got to consume it, whatever we're going to do with it. But as you go down lower and lower, marginally, there's less and less individuals or companies or whoever that are borrowing that money. So they've gotten themselves in this hole now, and the only way to continue to have leverage and to push people is to have basically more control over their money. And I think that's the trap they've put themselves in, and it's a very scary thought. One of the things that I've noticed, you probably noticed too, Lawrence Summers, Draghi, and a few others have been talking about getting rid of the high denomination bills. Lawrence Summers wants to get rid of the $100 bill. He wrote an article in our local paper, the Washington Post, 3-4 weeks ago. And the article is basically wants to take a bite out of crime, and certainly a true statement that getting rid of the large bills makes illegal transactions, especially blue collar type transactions, drugs, whatever it may be, laundering money, makes it harder when you have to deal with smaller bills. But I don't think Larry Summers cares about taking a bite out of crime. I think what he realizes is that if you get rid of the large currency, it makes taking money out of the bank harder as well. It makes storing it in a safe in your house a little more concerning, a little harder. And I'm not sure if they're going to get rid of currency completely, but I think they'd like to experiment to see, at a minimum, what effect they can have by just getting rid of some of the larger bills. But it's certainly hard to argue that that's not the first step towards getting rid of paper currency as we know it.
All these steps, whether it's negative interest rate policy, discussing cashless society, Larry Summers wanting to take away bills, these are all dystopian. I didn't think when I was in college and I was just starting to be an adult or learning how to be an adult, if you would have told me all these things would have happened within 10 years of me graduating college, I wouldn't have believed you. And yet here we are, and it seems things are only going to get worse in that regard with the craziness that these politicians and central bankers and treasury departments of governments have planned for we the sheeple.
Well, I think, unfortunately, if you put yourself in their shoes, let's say all of a sudden we elected Jason in charge of the Federal Reserve and the Treasury and the President of the United States. Unfortunately, the first thing that you would likely do and that I would likely do is bust some of these bubbles, is remove our dependency on debt, is start taking the right steps towards creating productivity and incenting productivity. And unfortunately, when you do that, you are going to pop the stock market, you're going to probably pop the bond market, and you're going to create a period of pain, of economic pain, and it's almost inevitable. So, as a leader, I would feel comfortable doing that, knowing that at the end we can be in a much better place. But I think the easy way out is just to kick that can a little bit more and cause the problem under the next guy's watch. So,
I don't think they're putting in the long-term policies to make
right.
the U.S. economy productive again. If I were, in the position where I could do that, where I could, fix the economy, where I was John Galt in Atlas Shrugged, taxes would be cut, government spending would be cut, there would be incentive programs in place for entrepreneurs and small businesses to make investments into the United States. So maybe you wouldn't pay taxes for 5 or 10 years if you invested in a new product or service or built a factory in the United States in order to start spurring job growth and things like that. But none of those things, to a large extent, are being done. So I would say, So I would say the policies that are being done, Michael, a lot of them are to pad the politicians' pockets so they can get crony deals, maybe so they can pay off bills because they don't know how they're going to fund a lot of the stuff. They just make promises they either can't keep, or they figure out that they'll just milk people more with taxes later and to pay for them. So I think, they're the people in power who are making the policy decisions, especially the people in Congress, they dump so much of the problems on the Federal Reserve, and the Federal Reserve doesn't want everything to collapse, so they just print more and more money.
That's right. And, we're in a society, too, where corporations run Congress indirectly, and they run the presidents, and they are deciding what's best for the country. And that's not necessarily what's best for us as individuals.
Yeah, I completely agree with that. But there's a lot of people who just graduated college who would kill for a corporate job right now.
Yep,
but
yep.
They'll figure it out later that they're not going to be that happy there.
Right. There's one thing before we go, I just wanted to bring up, which ties into all of this. And we're not going to talk politics at all, but very fascinating the support that Trump has got and the support that Sanders has got, even though it looks like he's starting to fade away. And to me, what that's telling me is that people really want change. And it's a different kind of change that Obama promised. They like them or not, they represent something very different than what we've traditionally had in that presidential seat. And this has been coming. We saw with Eric Cantor, surprisingly losing his seat. So it's something to keep an eye on. But the seeds of change seem to be growing. And I think that's, again, could be painful in the short run, but I think it can be very powerful to try to change a lot of these problems that this nation has had, and as a result of both Democrat and Republican policies.
Yeah, it looks like it's going to be Hillary Clinton versus Donald Trump for the nominations to run for president, because Hillary, regardless, the evidence, in my opinion, against her is overwhelming. She should have been charged already and probably should be on trial. But as you know, since you live outside D.C., that the system here, the political chain of command, there's a lot of people who are friends with Hillary, either in the Justice Department or in the FBI, and she's probably not going to end up getting charged at all, unfortunately.
Yeah, like I said, I'm not going to get into politics. But,
okay, well,
I will probably be voting for neither one of them. Let's put it that way.
Me too. Me too. I'm not sure it's even worth voting at all at this point. I mean, I view the U.S. economy as basically a runaway train. And, if Bernie Sanders would have won the nomination, he would have forced it off the tracks faster, probably because of the tax policies he wanted to put onto the middle class in the United States. He would have just choked whatever was left of the real economy. It just would have completely died even faster.
Right.
Well, Michael, I just want to thank you for your time today. If our listeners want to read your articles, how can they do so?
They can certainly go to the website, 720global.com. They can also send me an email at M as in Michael, P as in Paul, LEBOW at 720global.com, and I'd be happy to put them on our mailing list. And we're also published, like Jason said earlier, Zero Hedge picks up a lot of our articles, Seeking Alpha, See It Markets, a bunch of other outlets pick it up as well. So, but send us an email or look at the website.
Yep, and I think things are only going to get crazier as we head into November and election silly season too. It's going to be almost like professional wrestling, hearing the name calling and stuff from Trump and Hillary Clinton once the nominations are set. And the funny thing is, they used to be really good friends, the Trumps and the Clintons, and I think Trump was a registered Democrat for a long time until 2009. So this is going to get like really comical. The shock value, the stuff that's going to be said, and it's going to be pretty ridiculous, I think, going back and forth against each other.
I agree. It's Saturday Night Live is probably, if you got to buy a stock, buy Saturday Night Live. They're going to be the ones profiting.
Okay, Michael. Well, thank you for your time, and we'll have you on again in a couple months.
Sounds great, Jason. Take care.